And we keep our eyes peeled on that chart. We begin, though, with our talk of the tape, the early year rally, whether it is out of gas. Let's ask Adam Parker. He's the founder and CEO of Trivariate Research and a CNBC contributor. It's good to see you here at Post 9. We're going to get to the market more broadly in a minute. But what do you think is riding on this now? The first FANG report, NASDAQ's had a nice move to start the year.
Yeah, look, there's been some bellwethers reporting, and people have been asking about Procter & Gamble, things that have a broader reach, and I think Netflix is one of them. People understand consumer health. But I think the expectations are not that low, so we'll see. Because,
not anymore, because the stock's up like 30% since the last earnings report.
And maybe 60 cents lows, and maybe trades at 75 times 2023 cash flow. And so there's the bar, people need to believe this is not what they thought a year ago. It was kind of a work from home stock that over-earned. Now it needs to show a growth rate that's accelerating.
Do you believe the bounce back that we've seen in tech? Because, this was like left for dead last year, along with some of these other big names, and then they were able to rally back to start the year. There's a lot of skepticism around that, though.
Yeah, look, you saw our year ahead outlook. Our view was, well, if everyone thinks it's lower first and higher later, we'll take higher first and lower later, because...
Speaking of higher first and whatever happens later, Netflix, obviously, as you can see here, is jumping as the earnings are out. Julia Borson, as I mentioned, going through it as we speak. You're going to hear directly from her in just a matter of moments, but the street seems to like at least what is on the surface here. The stock's up near 8%. Actually, Julia's ready now. So, Julia, this looks good, at least in front of me. What do you see?
Yeah, I'm just going to dive into some of the key numbers here. First, I want to point out that paid net ads coming in much stronger than expected, 7.66 million versus the 4.57 million, which is the street account estimate, and the 4.5 million that the company itself had forecast. So big beat in subscribers. Earnings missed by quite a lot. The company reporting 12 cents in earnings per share versus the 45 cents that was estimated. Revenues right in line with estimates at 7.85 billion. The other thing I need to point out here is there's been a change in management. Reed Hastings was the original CEO. He became co-CEO with Ted Sarandos, and now he has become executive chairman. So Reed Hastings leaving the co-CEO role, becoming executive chairman, and co-CEO Ted Sarandos is now joined by a new co-CEO, Greg Peters. So this is a management change, not entirely unexpected, given that co-CEO transition that Hastings did with Sarandos. So it's sort of maintaining the through line there. And he's certainly going to be involved as executive chairman, but I'm sure we will learn about that more on the earnings call. I'm going to continue to dive into this earnings report here, but I think the main source of the stock bump right now really comes down to the better than expected subscriber numbers. And just to remind everyone, this is an accelerating growth number for subscribers. Remember, the first 2 quarters of last year, the company actually lost subscribers. Back over to you.